do the fundamentals support the gains that we have seen?
Oh, I would say absolutely. There's sort of two separate questions in what you said. One is sort of the magnitude, the size, and the speed of the rally, and that, I would argue, has just really all been about earnings. So S&P 500's up 15% year to date. Through the third quarter earnings, we were up in terms of earnings by 10, maybe 11%. And of course, we are now well into the fourth quarter. We are at 12 to 13% for the year. So really, the year-to-date rallies mostly just really come from earnings. The movement in the multiple is a couple of percent, so it depends on whether you count last Monday or 2 weeks ago. The multiple is going to move around. It's in fact been remarkably stable through the course of the year. So, the one sentence description of the last 12 months has been that it's just really all been about earnings. And so in terms of a forecast, what's going to happen at to earnings next year. And in thinking about what's going to happen to earnings, you got to think about, pretty robust U.S. growth. A big pickup really in global growth. And I would argue, the risks to global growth are to the upside next year. And then there's the question for U.S. earnings of what happens to the dollar. But if you, keep the dollar where it's at as, one possible baseline, we're talking about 11 to 12% earnings growth for next year. And that's essentially our forecast, which is that the multiple stays flat. It's mostly driven by earnings. It's mostly just like this year. Now, there's a separate question which you brought up.
Aren't we due for a 5% pullback?
Absolutely. Right. And I think, here, the thing that you have to keep in mind is that the quote-unquote normal behavior of the S&P 500 is 3% to 5% pullbacks every 2 to 3 months. We are now in the 12th month of the rally post the election without a 3% pullback. So I think it's a probability one event that we will eventually get what I would term, a normal pullback. Why haven't we gotten them over the last year? I think you've got to keep this rally in sort of perspective, which is that it follows a long period of range-bound behavior in the S&P 500 after we had the U.S. dollar and oil shocks. Growth slowed. There were clearly recession fears, sort of, the trough or the peak, depending on your perspective, was in Q1 of last year. And so what you see is, fund managers who generally tend to adjust their positioning with the growth pulse of the economy at very underweight levels. Our measures indicate that positioning, in late 2015, early 2016 was at lows for the entire recovery cycle. So as growth comes back, as the impacts of the dollar and oil shocks come out of the system in terms of growth and earnings, you've seen them move more and more, raise their positioning. And they're really who bought the dip. But I would argue it's in line with the improvement in growth indicators, but positioning is definitely long.